activity index for February. Now, the January index was at 23, and the expectation was for a slight decline to, it was 0.23, excuse me, forgot a decimal point. So January's number was 0.23. The expectation was for a decline to 0.18 in February. Instead, we dropped all the way down to minus 0.19, so the opposite side of zero. So weak economy. The 3-month moving average, though, I guess, moved up a bit from minus 0.26 to minus 0.13, but the data was still worse than expected, and it does show a contracting economy. And that was before this financial crisis started, right? This is all rear-view mirror stuff. This financial crisis didn't kick off until March, so none of this is in the February data, which was already bad. Same thing with new home sales. New home sales were originally reported for January at 670,000. These are annualized numbers. That got revised all the way down to 633,000. That's a big downward revision. And then even after that downward revision, the February number was still weaker than expected, although not by much. They were looking for 645,000, and we got 640,000. But I would expect that even though mortgage rates may have come down a bit in this crisis, I think that this is going to send an even deeper chill throughout the housing market. Because a lot of these community banks now are having a lot of problems, and a lot of these banks are the ones that are writing a lot of these mortgages. So there's going to be a problem here for the housing industry. Kansas City Fed Manufacturing Index for March, not really sure here. It came out at a zero. It was, the last month was zero. I'm not sure if this number is correct. It looks like a weak number, but I don't really have much data on it. But I pulled it up. I already went over the balance sheet. Durable goods came out today, and another weak number. So the January number for durable goods was initially reported at minus 4.5. Came out at minus 5. So that number is now worse than they originally told us. They had expected an improvement in February. It was supposed to be positive 1.5. Well, they were right. It was an improvement, but it wasn't into positive territory. We got minus 1% for durable goods in February. So back-to-back negative numbers. If you take out transportation, they were looking for a gain of 0.3. Instead, we got 0. And core capital goods, which was supposed to come out, well, actually, I don't know what it was supposed to come out. It came out at 0.2. But we did downwardly revise the prior month, which was originally reported as 0.8, and it ended up being revised to 0.3. The one number that had some strength in it was the PMI that we got today for March. And so this has some part of March in it. And it came out at 53.3. I don't know what they were expecting, but I know that the manufacturing part beat expectations. It was supposed to be 47.2, and it came out at 49.3. Now, it's still sub 50, which still indicates contraction, but not as big a contraction. And the service number was much stronger. They were looking for 50.3, and we got 53.8, which was a much stronger number than forecast. And I think the main reason for that is prices. I think in the service sector, we're really starting to see momentum building in price increases. And I think that's really what's going on with that stronger number. I think it's just higher prices that are responsible for the increase. Now, there was a temporary decline in the goods prices because we had a decline in energy and other commodity prices as the Fed had tightened, and that was taking its initial effect. But now that the Fed has eased, right, now that there are no more rate hikes, yes, Powell raised rates by 25 basis points because I guess he said he was going to raise and he didn't want to not raise. But now that he's told everybody that he's not sure what he's going to do now, right? It's like we don't really know what's going on in the future. There's a lot of uncertainty. So he, as I said in my last podcast, he's opened the door to not hiking rates, which means he's not going to hike rates because the market is going to make sure that they push the Fed through that door and there are no rate hikes. So the rate hikes are over. The only question is, when is the next rate cut? and how low will the Fed be able to take rates. I don't think they're going to get all the way down to zero again. I don't even think they'll get down to 1%. They will cut rates. They're just not going to be able to cut them that much because inflation is going to explode. And so that will, shorten the easing cycle. But of course, as inflation gets worse, that accelerates the amount of ease because not only are you lowering rates, but real rates are dropping even faster because as you're cutting rates, inflation is going up. And so the gap between yield and inflation just widens. But we're going to cut rates. Haven't done that yet. But just telegraphing to the market that you're done. That counts as a pivot as far as I'm concerned. I mean, is it a soft pivot because they haven't actually cut rates? Maybe. I don't know. I just think it's about as clear a sign as you're going to get. So anybody who's still looking for a pivot, you're mistaken. You got your pivot. It's here, right? And so you're just risking losing a lot by waiting for some official pivot before you change your investment strategy, to a defensive one against inflation because you're waiting for the Fed to really start cutting rates or cranking up the presses. They've already done that, right? But when it comes to quantitative tightening, that's gone. And not only did they stop quantitative tightening, they started quantitative easing. So what more evidence of a pivot do you need than that when it comes to what they're doing with money? Now, the Fed is denying, as I said on my last podcast, they're denying that this is QE because they're saying the intentions are different. So that's what makes QE, what your intention is. So QE is when you print money and buy government bonds and mortgages if your intent is to lower interest rates. But if you do the exact same thing, but you have a different intent, well, then it's not QE. Well, that makes no sense whatsoever, right? So it is QE. I don't care what these guys want to call it. And the only reason they call it QE is because they don't want to call it the only reason they call it QE is because they don't want to call it what it actually is, and that is inflation. And that's what they've been creating, and that's why we have this inflation problem, and that's why this problem is about to get a lot worse because the Fed has no choice. And in fact, Powell admitted that in the Q&A in a way when he refused to give any economic advice to Congress. He refused to criticize any of their policies. He just said, we take whatever fiscal policy we get and we just build it into our model and we just do our best. Well, that means inflation. If they've just got to take any deficits that Congress wants to hand them and they got to figure out, how to deal with it, well, they're going to print money. I don't care what they call it, QE, it's inflation. Even if it's not QE, it's still inflation. It's about to accelerate. And so everybody needs to do something now. Don't wait. Do it now. Yes, the price of gold is still below 2,000. It got above 2,000 a little bit intraday today, but it did sell off. Let me see where it ended up closing. It couldn't hold 2,000. Gold sold off close to 20 bucks. So it closed at 1972. Still a pretty strong close. Gold stocks shrugged off the drop in gold for a change and actually were positive on the day. So investors are now starting to buy some gold stocks, realizing that they're still super cheap given where gold already is. But most of these gold stock investors still expect the price of gold to go down as soon as this crisis is over. And again, they think that inflation is going to come down. It's not. Inflation is going to run out of control. But gold is strong. Yes, it hasn't closed above 2,000 yet. It will. I don't think there's much downside left. I don't think we're going to see 1,800 again. I think that ship has sailed. So I think if you got your eyes on prices that low, you're not going to be a buyer. You got to be willing to buy stock, gold here in the 1900s. I think buying below 2,000 is going to be a good price. You're going to look back at this a year or two from now and think of how cheap gold was when it was still below $2,000 an ounce. So you want to buy some physical gold. I know the guys at Schiff Gold, they're still working overtime. They're working weekends. They're taking your orders at schiffgold.com and, talk to the representatives at Europe Pacific Asset Management about getting your portfolios in order, transferring your accounts over. I don't know how much time we have left. I mean, I really think we're rapidly approaching the end of this, where the window is going to shut, right? And you have to have your financial house in order. You have to have all of
The Peter Schiff Show.
Today's episode is sponsored by Omaha Steaks, with high-quality beef that's naturally aged for the ultimate tenderness, juiciness, and flavor. To get $30 off your qualifying order, go to omahasteaks.com and use the promo code GOLD at checkout. Minimum orders may be required. See site for details. Well, I am back in Connecticut in my basement once again. Welcome to the 900th episode of the Peter Schiff Show podcast. 100 more episodes to go to get to 1,000. And, I want to report that I was able to return to the United States from the UK without any episodes at the border. And I think I mentioned this on a podcast a while ago. But for a couple of years, I had a very difficult time coming back to the United States. It all started shortly after the 60 Minutes defamatory broadcast that accused me of using my bank to help criminals launder money and evade taxes. After that, I noticed that I had a hard time coming back to the States. Whenever I came back and I was going through customs, they would see my passport and immediately would pull me aside. I'd have to go to a special room where I'd have to wait, and then I'd get interrogated by somebody, ask me a bunch of questions, look through all of my luggage, and then I would eventually be able to, come back in. And also, I don't know, about a year ago, or maybe not quite a year, I forget, but I lost my global entry. I had been a member of global entry for a long time. If you don't know what that is, it's something that you get, you apply with the government, you got to go down and they run a background check on you, and then they give you a global entry. You also end up getting TSA pre-check for free when you're a member of global entry, and you get this known passenger number with that. But it just means too that I could get back into the US quicker because you go to a shorter customs line. It's more automated. Well, anyway, shortly after I renewed my global entry, for like another 4 or 5 years, I paid the fee and I renewed it. And in less than a year after I renewed it, I lost it. I got told that I no longer had global entry. In fact, the only reason I found this out is because my pre-check was no longer working. And so I lost that because I lost my global entry. But I never got an explanation. I tried to get it. I even used Freedom of Information Act, but I could never get anybody at the government to tell me why I lost my global entry. But I think it all had to do with the investigation of me, because of the bank for money laundering and tax evasion. I must have been put on this list of suspicious people. And so my passport was flagged, and anytime I came back into the country, they just assumed that maybe I was out there laundering money. And so they wanted to, really check me out. Well, the first time that I didn't have a problem coming back to the United States was a few months ago. I came back to Puerto Rico from St. Bart, and, I was expecting to get interrogated, and they let me through. And I wasn't sure, maybe it was just, a one-off event. And so I was kind of nervous coming back into this country, not that they would find anything. I mean, I don't smuggle anything. I mean, so it's just a hassle that I have to take longer, to get out of the airport. After a long flight coming back from the UK, you don't like to spend a couple of hours, waiting for the customs officers to clear you. But I sailed right through. Just a couple of standard questions, no big deal. Got right back in. And so I think it's over. I think what happened was, while this investigation was ongoing, I was on this list. But the fact that I'm no longer on the list, maybe that tells me that the investigation is over. And I've assumed it was over because they ended the investigation on the bank a long time ago. But it pissed me off in that press conference that the Puerto Rican regulators called to announce the fact that they were putting my bank into receivership.
instead of allowing it to be sold to Kenta, which is the company that had bought it or was buying it, waiting for government approval. By the way, it's almost been a year now. It'll be a year on June 30th that my bank had been in receivership, and not a single customer has gotten any money back. I mean, all the money is there. I mean, there's not as much there now as there was a year ago because they've been spending it, right? But there's still enough there to make everybody whole, as far as I know. But nobody has gotten a nickel yet because of this government process. But during that press conference, the IRS guy was there, the top IRS guy in the criminal division. And he disclosed the basically failed investigation of my bank because no charges were filed, because no evidence of any wrongdoing was discovered. But he made it sound as if we were doing something wrong. We just, got away with it, right? But somebody asked him, well, what about Peter Schiff? Is Peter Schiff under investigation? And the guy said, well, we're not allowed to comment on who may or may not be under investigation, after he just finished talking about how my bank was under investigation for 2 years. So if you're not allowed to comment on investigations, then why the hell did he comment on the investigation about my bank? Especially since he knows the investigation exonerated my bank, yet he didn't want to mention that fact. So he just wanted to pretend that the bank did something wrong. It's just that, nobody got charged with anything because I guess they couldn't quite find enough evidence to pin it on anybody, but they just assumed that this bad stuff was going on. But with respect to the question about me, he just said, well, I can't comment on whether or not Peter Schiff is under investigation. Now, why not? I mean, he just commented on the bank. Now, I don't think he should have commented on the bank. I think that was wrong. But once, he had the precedent of doing that, he could have said, well, no, we're not investigating Peter Schiff, or we did, but we closed it. No. He didn't comment on it, because I think he wanted to leave the false impression out there that there was some open investigation about me. And so that's why I haven't been charged yet, because they haven't finished the investigation. They wanted to leave that specter out there that, yes, Peter Schiff may be guilty of these crimes. We just haven't finished the investigation yet. And so it's an open matter. And, they never want to come out and say there's no more investigation. But the fact that I can now return to the country, to me, is some indication that maybe they did officially close this investigation, to the extent that, I'm no longer on the suspect list of money launderers or tax evaders. And so I can, come back into the United States without a hassle. So, I mean, that was comforting, because I've been traveling under this stigma. And I finally ended up getting my TSA pre-check back, but I had to get that directly. And I got approved for that. So I lost the pre-check. I mean, the global entry. And maybe I would get it back. I don't even know if I applied again, maybe they'd give it to me. But they never told me why they took it away in the first place. Anyway, I'm going to get on with the podcast. First thing I want to discuss is the jobs numbers, the weekly unemployment numbers that came out yesterday on Thursday, because this was a disappointment to the markets in that there was a big spike in weekly jobless claims. The prior week, they were at 223,000 claims, and it jumped up to 261. That's a big jump in a single month. I mean, way above expectations, but a very large jump. And in fact, the number of people filing first-time unemployment claims is now the highest since October of 2021. So in the prior week, the markets were celebrating or heralding this great jobs report when all these jobs were being created. And now we get a very bad weekly unemployment number, a week later. And again, I have been very suspicious, and I've been voicing my suspicion on this podcast of the jobs numbers. We've had, 12 out of the last 13 jobs reports have beat estimates. And these labor numbers, or these job numbers, this is what everybody is hanging their hat on, to claim that we have a good economy because we have this supposedly strong labor market. Well, the employment numbers have been the only good numbers, and they're only good superficially, but they're the only ones that are. All the other numbers are bad on the surface, and they're even worse when you dig deeper. So the unemployment numbers are the outlier. But they are inconsistent because remember, even though we keep getting these official job reports that are stronger than expected, the household survey, which is released at the same time as the official numbers and doesn't really get much media attention unless the official number is bad and the household numbers are good. See, when that happens, the media finally talks about the household numbers. But when the household numbers are bad and the official numbers are good, well, the household numbers don't even exist, right? Nobody wants to talk about it, especially when, you got Joe Biden in the White House and the media wants to pretend we've got this great economy. So they want to ignore economic data that would cast doubt on that narrative, and they want to just focus in on the data that seems to support, this robust Biden economy. But the fact that you've got this big contradiction between the household numbers and the establishment numbers, that in and of itself casts doubt on the jobs numbers. But then when you see these unemployment numbers, that's also an inconsistency that casts doubt on these numbers. The layoffs that are announced every week cast doubt on these numbers. So there's a big cloud, I think, surrounding all these unemployment numbers. And so I think that you can take them with a grain of salt. And to me, if you're going to look at the unemployment numbers and say we have a good economy because we still have, this strong labor market, then you have to believe that all the other economic data
to coincide with the final day of the first quarter for the markets. But we had some connectivity issues here in Puerto Rico, and I lost internet. I actually had two services, and neither one of them was working. So finally got everything up and running, and so I'm doing the podcast today. Oh, but let me, I got to get something out of the way first. A lot of people have been waiting a long time for this. But, and I thought I would never actually, do this. I mean, it really is a major epiphany for me to have to admit that I was wrong for all these years. But I've finally seen the light. You guys, all these text messages and emails, they finally worked because I've seen the light and I am buying Bitcoin. Gold, forget about gold. You're right. It's old school. It's too clunky. It's too heavy. I want something with real value for the digital age. I finally, I was stuck in this mind frame, because I'm an old guy, I'm set in my ways, and I just couldn't, get with this new technology. It just took a long time for it to really sink in. Some of you guys, you got it right away. But, it just took a long time. Now I'm 60 years old. And, so my brain doesn't work quite as rapidly as you 20-year-olds, right? So you were able to figure this out, quickly. But it just took me some time. I had to watch Bitcoin get all the way up, to 70,000, although it's pulled back right now. It's 28,000, something like that. But, I'm buying. You guys got me. So selling my gold. And I'm recommending that everybody who follows me do the same thing. Anyway, April Fool, if you believe that. Now, I know somebody is going to try to take what I just said as my April Fool joke, and they're going to cut it, and they're going to put it up on the internet as if it wasn't a joke, because that's how you Bitcoin guys operate. You like to take things out of context and misrepresent stuff. And so, yeah, you'd have to be a real fool to believe that I would be foolish enough to buy Bitcoin. Now, yeah, Bitcoin had a great quarter, and I'm going to get to that, but enjoy it while you can, because it's not going to be repeated. Because the real fools this April Fool Day were the people who were buying all these tech stocks during the first quarter, including cryptocurrency, Bitcoin, all this risk stuff got bid up in the first quarter of 2023. A lot of people got caught off guard by the strength that we had in risk assets in the first quarter, right? The NASDAQ, in fact, the NASDAQ had its best quarter since the second quarter of 2020. It was up 17%, I believe, on the quarter. And the reason that the NASDAQ did so well back in the second quarter of 2020, that's when the Fed, went back to QE. That's when they slashed interest rates back to zero because of COVID. Now, the market sold off early on when COVID first got started. But once the Fed went to zero and launched QE, infinity for QE4, that caused the NASDAQ to snap back very sharply. And so you have to go back then to find a quarter where the NASDAQ was as strong as it was in the first quarter of this year. Now, of course, the NASDAQ went way down. It was down about 30% for 2022. So big move down. It's not that crazy that we had a snapback. Plus, I think a lot of people were probably short a lot of these tech stocks going into the year. Certainly people who were short these stocks made a lot of money on those shorts in 2022. And so a lot of them were probably still there in 2023. And the expectation, of course, was that the Fed would keep hiking rates. And in fact, it did. We had 75 basis points of rate hikes during the first quarter of 2023. So that is what the markets had expected. And all of that, of course, had been bad for tech stocks. But the reason we got the sharp turnaround is because of the economic events, and most particularly the onset of the 2023 financial crisis that really changed the mindset. And I think even prior to the onset of this financial crisis, you were starting to see a bid in the tech stocks based on the idea that the tightening cycle was coming to an end. Yes, maybe the Fed was going to ratchet up rates a couple more times, but it didn't matter because the lion's share of the work had been done. And we were now on the cusp of another easing cycle. The Fed was soon going to be cutting rates. And of course, quantitative tightening would eventually give way to another round of quantitative easing. And so investors wanted to get ahead of that. Remember, the markets look forward. So they're looking beyond the last few rate hikes to the first rate cuts. And not just the first rate cuts, but the many, many rate cuts that are likely to follow, as well as the return to quantitative easing. And I think that is what is responsible for the big rise in the NASDAQ. And if you look at what happened with the Dow, for example, the Dow was barely positive. In fact, it may have been negative up until the last day of the quarter because the Dow was up 400 points on Friday, and the Dow only gained 0.4% for the entire quarter. So I think all of that gain was attributable to Friday's rise. So, but for that rise, the Dow might have had a negative quarter. But the S&P 500 was up about 7%, and what powered the S&P was the tech stocks that are large components of the S&P. Certainly other sectors of the S&P, like the financials, did extremely bad, right? The financials got clobbered, especially at the latter part of the quarter. But the tech stocks were strong enough that it outdid the damage done by the financials. But if you look at, let's say, the Russell 2000, which doesn't have nearly as much tech as the S&P or the NASDAQ, obviously, that index was only up 2.3%. So not nearly as big a bounce. Now, I didn't participate as an investor. I didn't own much of these tech stocks. Actually, I did own some of the Asian stocks. I had some tech stocks in Asia. Some of them are in our funds. So we caught a bit of the tech rally, but we're way underweight tech in general. But where we were able to participate was in the gold stocks, because the gold stocks had a decent quarter, not a spectacular quarter, but they had a decent quarter. The GDX was up 13% on the quarter, and the juniors actually didn't even do as well. They were up about 10% on the quarter. Now, for those of you who are shareholders of the Euro-Pacific Gold Fund, we actually did a little bit better during the quarter than both of those index. The Euro-Pacific Gold Fund was up 14.2% during the first quarter. So not nearly as much as the NASDAQ, although actually not that far behind. 17% versus 14%. So almost as good as the NASDAQ, but a lot better than the S&P, and certainly even more better than the Russell 2000 or the Dow. And what I think should be going on right now is more people who are buying these tech stocks should actually be buying gold stocks instead, because I think the gold stocks are the new tech stocks for this new easing cycle. The people who are buying tech stocks all quarter were correct in their judgment that we were coming to the end of the tightening cycle, because we were. And they were correct to anticipate that there would be an easing, which there already has been. I mean, the Fed has already acknowledged that it's probably not going to hike much, if at all. And whether they want to admit it or not, they're back to quantitative easing. Although this week on Thursday, when they reported the balance sheet, it actually shrank again by about 25 billion. So we didn't have a third week in a row of an expansion. There was a little bit of a contraction, but I think that is the exception, not the rule. I think going forward, we're going to see the balance sheet continue to expand. Every once in a while, there may be a weekly contraction, but the direction now for the balance sheet is up. But I think investors are wrong in thinking that this easing cycle is going to be good for tech stocks. I think they've got it wrong. The last easing cycle was great for tech stocks, but I don't think that we're going to repeat that. I think this time around, it's going to be gold stocks. And in fact, if you go back to the 2000 bubble that popped, and NASDAQ was down 80%, mostly because of those tech stocks, the tech stocks rebounded from 2002 to 2008 when we had the financial crisis. But the gold stocks did much better during that easing cycle, because the Fed moved rates down to 1% and then kept them there for a while and then gradually normalized. But during that entire cycle, the gold stocks actually did much better than the tech stocks. So I think the same thing is going to happen this time. It's not going to be the people in tech stocks are going to make money again like they did from 2009-ish all the way through 2021 or whenever that bubble finally peaked. It's not going to be the same, nor is it going to be the crazy days of the COVID lockdowns where all these tech stocks, went ballistic. Because what I think investors don't get is that inflation is the wild card.
State that your position on the housing market and how long refis can keep. State your position on the housing market and how long refis can keep going. Look, the refis are keeping everything propped up. And if it wasn't for the Fed going to QE infinity, the refi well would have run dry. I'm sure that it's all the Fed printing money that's making these refis possible at these rates. So, and that's just, that's just the road to a hyperinflation. That road is paved with a lot of these refis. Lowell B. I own 9 acres outside from a large commercial development. I plan to subdivide into commercial lots and do storage units. Should I sell and purchase silver and gold? Look, I don't know the dynamics on that, on those storage units. Look, I think demand for a lot of stuff is going to go down. So depending on what price you can get, but you should definitely buy some silver and gold if you don't have any. If you don't, you should buy some. I mean, everybody should have some. Now, if you already have some, how much more do you need? I already threw out a number of 5 to 10% of a portfolio. So if you're not at that level, you can certainly top it up. Eugene Maravev also asking me about Russian stocks. I already mentioned, I'm sure there's some great buys in Russia. I actually made a lot of money in Russian stocks in the late 1990s. I was buying stocks, Lukoil, Preferred, Surgutneftegas, Hurricane Hydrocarbons, which became Petrokazakhstan, which wasn't Russia, but it was in that area. And I was buying a lot of these stocks, and I forget some of the weird Russian names. And I was buying them in the late 1990s when oil prices were about where they are now. And then oil went up to $150 a barrel. And yeah, I made a ton of money on those stocks. That one, Hurricane Hydrocarbons, I bought it at $5 initially. It went down to 25 cents. Talk about a disaster. It went from $5 to 25 cents. And then it went from 25 cents to $55 and was bought out all cash. Takeover by, I think, China Petroleum. Paid $55 a share cash. No reverse splits, right? It was the same exact number of shares. So I had the same amount of shares at 25 cents. And I bought more on the way down, actually, personally. I had some clients that bought it. But I had the same amount of shares when it was at $55. And by the way, like a couple of years earlier, they declared a special cash dividend of $2 a share. So $2 was more than I paid for the stock. And I got it all back in a cash dividend before I ended up getting $55 a share for the stock that I basically got for free, because the $2 that I got in a cash dividend was more than my entire cost for the stock. But believe me, I made that money the hard way. How many people are going to ride a stock from $5 down to 25 cents? And of course, I've ridden stocks from $5 to 25 cents and then from 25 cents to zero. So they don't all work out that way. But this was an oil play. And so I'm sure there's some out there that they're going to do that again, right? That are going to have that kind of value, because people throw it all out. They throw out a lot of babies with the bathwater when times are bad. You just have to know which are the babies and which are the bathwater. Oh, just by the way, for the regulators too, because I went over that story, past performance is no guarantee of future success. And just because I hit a home run on that stock doesn't mean I'm going to hit it on every stock. In fact, I won't. That is a rare exception, but it's just an oil story that I wanted to relate from that time period. Okay. When talking about crypto, why don't I talk more about stable coins? Well, stable coins are fine, but that's not what everybody's buying. Nobody wants a stable coin because you can't make money in a stable coin. I mean, it's just stable, right? People want to get rich. That's what crypto is about right now, is getting rich. But look, if you have a cryptocurrency backed by gold, it's all fine. The problem is the government hates that. They're going to regulate the hell out of that. They don't want people using gold. That's the problem, right? They don't care if they use Bitcoin. I mean, because they know that's going to crash. And but they don't. Bitcoin is not a threat to the global monetary system. Now, they don't like it if drug dealers and money launderers and terrorists and tax evaders use it, right? So they know that threat, and they're going to clamp down on that. But they know it's not a threat to the monetary system, right? It's not like gold, right? If we had a convenient stable coin backed by gold, everybody would use it, right? And so that's why it would be a threat to the fiat monopoly. But not everybody is going to use Bitcoin because it's not practical to use it in commerce. You can't, as I said earlier, you can't price stuff, and it's too volatile and it has no intrinsic value. Gold would actually work. That's why the government would be afraid of it. Bitcoin doesn't work. It only works in its mind to help people evade taxes. And so that is the problem that they see. And they're already going after that with regulations. That's what drove Goldmoney. Goldmoney wanted to offer cryptocurrency trading, and they did for a while, until the regulators made it so expensive that they had to stop doing it, right? So that's what happened, and it was all the AML, the money laundering stuff, that it became too expensive. We couldn't make any money because all the money was spent in compliance. Okay, Nolan Stout, $10. Which government departments should be eliminated and which should be kept? Well, it's real easy. Go back in the Constitution and see which departments are authorized, and pretty much those are the ones we need. I mean, most of them should be eliminated. We don't need most of these government agencies and departments. The federal government should be principally involved with national defense, right? So we need a Defense Department. I don't think we also need Homeland Security. I think the Defense Department can cover the homeland, especially if we stop, meddling in so many, foreign problems with our military, that we would have resources to defend the homeland. That's what it's supposed to be. Yeah, we need a Department of the Treasury, not like the one we have now, to borrow money. I don't want to be that. I want a Treasury that's full, not a Treasury that's empty and that's loaded up with IOUs, but we still should have one. We should have a Secretary of the Interior, not to pay farmers not to grow food and stuff like that, but we do need to take care of that. I mean, I don't even know that we need a Commerce Department. I mean, all they've done is create problems. But if they did what the Constitution specifies, really regulating interstate commerce instead of interfering in interstate commerce and pretending that they have the right to regulate companies that engage in independent commerce, which they don't. The Supreme Court was wrong to expand constitutional authority to regulate the companies that engage in commerce instead of the commerce itself, which is all the Constitution empowers the federal government to do. But look, Almost everything that happens in your state should be handled by the state government or by the people. That was the vision of the founding fathers. It was that federalist system of limited small federal government where the power was retained by the people and by the states, sovereign states with a limited federal government, with gold money, sound money. The federal government was not given the power to print money. They don't have that power. All they can do is coin money, which is gold and silver. Because no state can make anything but gold and silver legal tender. The federal government is given no power to make anything legal tender, so it can't. So constitutionally, the only thing that can be legal tender in America is gold and silver, and the only thing the federal government can do is take that gold and silver and make it into a coin. But we need to get back to constitutional government. If we do that, we will create wealth unlike the world has never seen, because we have a lot more capital, we have a lot more technology, and a lot more know-how. Intellectually, as far as our technology, we're miles ahead of the founding fathers. We're way behind them when it comes to our economic understanding. So we don't understand economics as well as the people did 250 years ago, but we understand, physics and thermodynamics and, computer, quantum mechanics, all that stuff, right? We understand all the science more. We have more knowledge now than we had then. So capitalism, if we really embraced it the way we did back then, we can create more wealth faster today than they were able to do in the 19th century. The 21st century can explode with prosperity if we choose the right door. That's why I'm doing this. That's why I'm out here educating people. So we choose the door that leads to freedom and opportunity and prosperity. We don't choose the dark door to government, socialism, totalitarianism. That's where we're headed. Unfortunately, we're on that path. I'm trying to get us to veer from that path. I don't know if I can do it, but I need your help, right? We need to get this. This is a good podcast to start. Get people. I had over 200,000. Let's see if we can get 1 million people. Look, this thing is going to go up on YouTube. This is my challenge. Let's get this thing to 1 million views. Share it with everybody you know and say, hey, sit down. You're at home. You got nothing to do. You're quarantined. Spend 4 hours. Listen to Peter Schiff answering these questions. Understand, right? Wake up, right? We're all living, in this fantasy world of the Matrix, right? And I'm trying to get people to take the pill that opens their eyes to reality, right? I'm like the Morpheus here. So spread this video and let's watch it. I mean, it would be great if we can get this. That's my birthday present. It's my birthday. Give me 1 million views, 1 million views on this YouTube video. I mean, I see little kids playing with toys that get 1 million views, right? This is valuable information I'm putting out there. And we need 1 million people to learn it. Okay, fractional reserve banking. I already talked about that. And Joe, what do you think about gas, oil stocks, utilities, tobacco stocks? They're getting killed. Look, interestingly enough, look at the U.S. oil stocks today. Look at the difference. Chevron down 8%. ExxonMobil down 4%. It's coming back. They were low. But look at European stocks. Total, a French company, is up 13%. That's one of the ones that we own, I know, in our portfolios. We own Royal Dutch. It's up 3.5%. So foreign oil stocks are up, right? And domestic oil stocks are down. And I think the valuations are much better. You look at the dividends, look at the yield, which obviously could come down now with oil prices. But the yields on the foreign stocks are much better. So if you're going to buy oil stocks, and I think we should be buying oil stocks, don't know where the bottom is. We definitely should be buying them. If you opened up an account with me today, I would buy you oil stocks. Tobacco stocks, yes, we have tobacco stocks. We own some tobacco stocks. I think there's great yields on these tobacco stocks. I'm not a smoker, and there's some people that, conscientiously tell us, I don't want to buy a tobacco stock. If that's your deal, we don't have to put a tobacco stock in your portfolio. But if you just want a good investment, personally, I think there's a lot of good dividend yield in these tobacco stocks. Utilities too. We have utilities. Telecom, we're overweight that sector. But again, I want to buy the value outside the United States. I don't trust the stocks in the United States. I don't trust this government. I don't trust the Biden government that's coming. I don't trust this Federal Reserve. There is massive political and economic risk. I think the United States right now is probably one of the worst countries in the world that you can invest in. I mean, now, it was a great place to invest during the bull market that spanned 10 years. And had you listened to me, I was saying this back then, I thought the U.S. was too risky. And as it turned out, with the benefit of hindsight, it wasn't. Now, you got the Russell 2000. It's just wiped out 7 years of gains in 2 weeks. So, that prediction is rapidly coming true. So if you wait a couple more years, it will be true. I think I will be proven right that the U.S. was the worst place to invest if you remained in there. But yes, we just had a period of time where the U.S. was the best place to invest. But remember, from 2000 to 2010, it was one of the worst places. All the markets did so much better. Foreign markets, emerging markets, commodities, gold, everything kicked the hell out of the U.S. stock market during that lost decade. Well, if you thought the first decade of the 21st century was lost, where do you see this decade? The 20s? Yeah, they roared in the 20th century, right? They are going to crash in the 21st century. Right? This it's going to be worse than the 30s were in the 20th century. So yeah, I mean, I ship the U.S. Market, and I'm bringing it to the safety of foreign markets, which I think offer a much better risk reward. Nothing's without risk. Everything you do is risky, including holding cash. In fact, personally, I think cash is among the riskiest things out there. I think what everybody thinks is safe is completely risky, because when you talk about the dollar being safe, treasury bonds being safe, they're only safe if you assume the dollar doesn't collapse. But the minute you assume that the dollar could collapse, if there's hyperinflation, then how can a treasury bond be safe? How can a CD be safe? It can't. It's only as safe as the currency is sound. And if we're printing it like crazy, if there's no limit to how much we're going to print, which is what Fed just said, Neil Kashkari on CNBC, CBS on 60 Minutes last night, when you have the Fed announcing today, Q and infinity, that they'll buy as many bonds as needed, from mortgage backs to munis to corporates to treasuries. How can anybody?
For Trump to beat Hillary Clinton in 2016. Anyway, what I want to wrap up this podcast, though, talking about is Tucker Carlson out at Fox News. Two of the guys whose shows I was on the most, Don Bongino and now Tucker Carlson, are both gone from Fox. I used to do both their shows. Now, maybe that means Laura Ingraham is next. Hopefully she sticks around, because she's the only person left on Fox News who has me on. Now, I go on Fox Business. I go on Liz Clayman's show. I go on Charles Payne's show. So that's another network. But Fox News, which has a bigger platform, there were 3 shows that I go on, and now 2 of the hosts are gone. But by far, I think Tucker Carlson was not only the best host on Fox, he was the best host on any news network, cable or broadcast. He was by far the best. In fact, I talked a lot about his recent podcast about the dollar's reserve currency status. But more than that, I mean, he called out all the hypocrisy regarding the war in the Ukraine and COVID. I mean, so many things. And when they were doing the George Floyd stuff, and I mean, so many things, he had the guts to come out and speak the truth. When nobody else wanted to speak the truth, everybody else in the mainstream media wanted to be politically correct. They were kowtowing to all of that pressure. And Tucker had pressure, because a lot of advertisers who would have advertised on his show, the #1 show on cable news, not just the #1 show on Fox, the #1 show in all of cable, right? But some advertisers were afraid to advertise because they're worried that some left-wing nut is going to boycott them because Tucker Carlson is telling the truth. When you're telling lies and there's someone out there telling the truth, you got to silence that person, right? You want to be able to tell your lies and have other people not call you out, right? And he had a big soapbox to call out all these lies. And he had a lot of people, a lot of fans, myself included, who enjoyed watching his show because he was very unique. Now, of course, I'm like Tucker in that respect, but I'm just here on, Peter Schiff Show. I don't have a Fox News platform. I'm not the host of a show like that. His audience is more than 10 times as big as my audience. And, it's easy for me to speak the truth. I mean, I gotta, give it, applause for Tucker, because to speak the truth in that corporate environment, knowing what the consequences are, right? Hey, I'm my own, right? I mean, I can speak my mind. And yeah, maybe they ended up shutting down my bank. The media destroyed my bank because they didn't like what I said. But I can't get fired, right? I mean, because I don't have a boss, right? I'm just direct to my audience. I'm not dealing with a big corporate structure. But he was in that world. And even though he was with Fox, yes, Fox is Republican, but they're not libertarian Republican. They're, mainstream, George Bush, military industrial complex. They're not Tucker Carlson. Tucker Carlson pushed the envelope at Fox, right? And that's the reason that he was so hated. I mean, you look at all the people that are celebrating and popping the champagne because Tucker Carlson was fired. Look at all of his enemies, because his enemies, the people who were Tucker's enemies, those are the people that you want to be your enemies. When all those people are celebrating that you've been fired, Tucker was doing a good job. He was an important voice that needs to be heard. And it's a shame for Fox that they caved into the political pressure, because you don't know why they fired him. Yeah, they got this big lawsuit from Dominion that they settled, the defamation lawsuit, but that wasn't Tucker's fault. Tucker didn't do that. So I don't know what else was a catalyst, but I think the problem was they were worried about Tucker and the things that he says because of how honest he is at calling out the hypocrisy and the lies of the establishment, of which, Fox is part of the establishment. Now, they're not nearly as bad as CNN or MSNBC or ABC, CBS, NBC, all those, but they weren't Tucker. Now, they allowed Tucker. To their credit, Fox allowed Tucker to speak his mind for as many years as he did. But at some point, they must have decided that it was too much for them. But I think that this is going to end up being a loss for Fox News. It's not going to end up being a loss for Tucker Carlson, because there is a big market out there for what Tucker Carlson is saying. There are a lot of people. I mean, I tap into part of that market myself, so I know that it's out there, and I know that he can reach it. He doesn't need Fox News. He's got a big enough audience already, and Fox News certainly helped him cultivate that audience. I mean, I can imagine the size of the audience I would have if I had a multi-year run on Fox News. I mean, I think I could have a very successful program. Plus, he's got a whole bunch of writers and producers. I do it all myself. I just make it up. I don't have people writing scripts for me and stuff like that. But I'm sure if I was up there on that big a soapbox, I'd have a big audience too. Maybe not as big as Tucker's. I don't know. But he's got a great audience that he wouldn't have had. But he can take that audience, especially with the internet and social media. He doesn't need to sign a deal. I mean, there are other broadcasts. He could do One American News. He could do Newsmax. He could do something with the Daily Wire. But I think that he should just go out on his own. I'd love to do something with Tucker, but Tucker don't need me. He doesn't need anybody. He can do it all himself. And I look forward to being a guest on the Tucker Carlson show whenever he starts producing it. In the meantime, I think Fox is going to lose a lot of viewers. There are people that are pissed off, and rightly so. I mean, my mother, I didn't put her up to it. My mother, who's a big fan of Tucker Carlson, she tells me, I'm never watching Fox again. My wife doesn't want to watch Fox either. It's like we can't turn on Fox News. My mom canceled her subscription to whatever. I forget what I don't subscribe to it, but my mom subscribes to some paid Fox Now, or I forget what it's called. But she says, I'm canceling it. And if my mother is doing that, I mean, I'm sure that lots of people's mothers and fathers and sisters and brothers are having a similar reaction. They're just really upset. They feel like Fox sold them out by firing Tucker. and they want to show their support for Tucker Carlson by, boycotting Fox. And, a lot of people that tuned in to Tucker Carlson's show, 8 to 9 o'clock, well, they watched 9 to 10, right? They stuck around. So Tucker's show and his popularity benefited the shows that came later. Well, now they're not going to get the benefit of Tucker's audience not turning the dial because Tucker's audience isn't going to be there. And there are a lot of other alternatives to Fox News now and other ways that people can get Tucker. So all the people that are out there that are so happy that Tucker Carlson is off Fox News, be careful what you wish for, because he may even be more effective and speak even more freely. I mean, imagine the stuff that Tucker Carlson said when he was still under that Fox News umbrella. Imagine what Tucker Unleashed is going to say. I look forward to that, and I wish Tucker Carlson Godspeed in his new adventure in this next stage of his career, which I think will be the best yet. Anyway, thanks everybody for listening, and don't forget,
it's a good investment, and I lost all my money. It had the SEC's seal of approval. They don't do that. They don't tell you that, hey, this company is going to work out, right? That's part of the disclosures. You can't say that the investment's going to be good just because the SEC has approved it. They've just said it's legitimate. We've done all the things that the SEC requires, but you invest at your own risk because, the SEC doesn't know about the market, right? Things can go wrong. The business model might not work. So just because the SEC is allowing the IPO, it doesn't mean that it stands behind the investment merits of what is going public, right? But I think that if you are an investor and you buy an initial public offering where the SEC has given the company the green light to go public, how can that same SEC a couple years later file a lawsuit against that company claiming that what it's doing, which is exactly what it said it was going to do in the prospectus that the SEC allowed? They're filing a lawsuit because Coinbase is doing exactly what it told investors and the SEC it was going to do before it went public. If what Coinbase is doing violates securities laws, why didn't the SEC say something before it went public? I mean, they obviously looked over what they were doing. If they were trying to bring public an illegal business, that was the time to say something about it. Because people invested in Coinbase, right? Yes, they didn't know if it was going to work out, but they at least thought what they were doing was legal. They didn't think they were running an illegal operation. But that's exactly what the SEC is accusing Coinbase of doing. They're saying Coinbase is running an unregistered, unlicensed securities exchange. Well, that's exactly what they were doing when they went public. They haven't changed their business model. It's the same business model that they reviewed when they approved the IPO. So to say that the government is going to basically sucker all these investors, allow them to buy stock, and then come and pull the rug out from under them and say that it's illegal. Look, that's another department that we should get rid of, the SEC. I don't think we should have an SEC. I'm not sure how many people work there, but we can save a lot of money. Let's get rid of the SEC. Let's get rid of FINRA. That's another regulatory body, which is not even part of the government. It's a private body that the government requires all brokers to be a member of. So I guess that wouldn't save the taxpayers any money because it's the investing public that has to pay the cost of FINRA. But the taxpayer does pick up the tab for the SEC. So if we're looking for ways of saving money, let's get rid of the SEC because clearly it's worthless. Because if what Coinbase is doing is so bad, why didn't they say so a couple of years ago? Why are they allowing the company to go public only to come back and say just 2 years later that what they're doing is wrong? Anyway, another thing, a topic I just want to discuss, because there's a lot about the commercial real estate market. I've talked about it. I've warned about it. So a couple of days ago, I went down to Yahoo Finance. I did an interview there. I'm not sure if they've posted it yet, but I did this interview. And when I showed up at Yahoo Finance, the guy that was there gave me a tour of their office. Very beautiful office in a high-rise building, lovely building. And this is a Monday. I'm there Monday at about 2 o'clock. Right? It's not a holiday. It's just a regular Monday in early June. Right? Everybody is supposed to be at work, except nobody was there. The place was completely empty. I actually took a little video and I posted it on my Instagram. Remember, I couldn't post the video on Twitter because I'm locked out of Twitter, but it's on Instagram, so you can check it out there. And by the way, again, as I said at the beginning of the podcast, follow me on Instagram and Facebook, because that may be where I put content for a while I wait for Twitter to let me back on their platform. But I took this video of all of this empty office space. There wasn't a single person there. And the guy told me that before COVID, every desk that you see in that video had a person sitting there and working. It was very busy. There was this large cafeteria that they had just so, a perk, because if you worked there, you got all this free food. There was nobody there. And he said they used to actually had chefs there that would cook the food. But since there was nobody showing up, I guess they didn't need the chefs anymore, so they're not there. I mean, there's still some cold food there. I walked around. There was some stuff that I could have eaten, but there was nobody cooking anything because they didn't want to cook when there was absolutely nobody there. But the point is, what is this office space worth? Because nobody is there. You've got all these companies that have all this office space, and nobody is using it. And I was able to see through the glass 4 or 5 stories down, and I could look through the glass at all the other offices that were below Yahoo, right? Totally different companies. Those were all empty too. I mean, just looking through it, empty desk after empty desk, nothing on the desks, nobody walking around in the hallways, just a complete ghost town. And this is before AI. I mean, people are working from home, but what about once we fully implement AI and people can use AI instead of employees? Obviously, if you're going to have a bunch of AI, you just need one closet where you put all those servers and those CPUs or whatever it is that you need to run the AI, right? You don't need a nice big office with beautiful views, and you don't need a cafeteria to feed your AI, right? They'll work 24/7, right? You just need the power to keep them going. So what's going to happen to this commercial real estate market when you've got big increases in interest rates? I'm here in the UK. Short-term rates in the UK are over 5%. You know where they were a year ago? They were 0. So they've had a huge move. And you know what they don't have in the UK? Fixed rate mortgages. Now that's going to residential. They don't have that. No, maybe people have 5-year mortgages here. They don't have 30 years like we do in the US. So, but in commercial, everywhere, nobody has 30 years really. It's a lot of short-term debt, 5-year debt. A lot of that stuff is maturing. So you own a commercial building. Your rents are collapsing. And even if they haven't collapsed because your tenants were locked into leases, what's going to happen when those leases mature? Are your tenants going to renew? Of course not. They don't need the space. So rental income is going to collapse. At the same time, interest rates are going up. See, commercial real estate is like a bond. The price of the real estate, the value, is a function of interest rates. The cap rate is interest rates. So if you have lower interest rates, then the present value of those rental streams is worth more. But you have a double-edged sword. If at the same time interest rates go up, your rental incomes go down, it is a perfect storm for the real estate market. And again, add to that the AI, which may increase or decrease rather the demand for commercial real estate, on top of the fact that so many people are now working from home. You're going to see a crash in the commercial real estate market. Now, that also has broader implications for the banks and other lenders who are not going to get repaid, because a lot of this commercial real estate has debt attached to it. And so the values are likely to fall so much that the losses are not going to just accrue to the owners of the commercial real estate. They're going to accrue to the lender, because once you've exhausted the equity. Let's say I bought a building and it was worth 200 million, and I had 100 million of debt. I was like leveraged, 50% debt. And so the bank probably thought that was a pretty secure loan, right? We've loaned $100 million on a $200 million office building. But if that office building is only worth $50 million, the owner doesn't lose $150 million. The owner just loses $100 million, right? He walks away from the other 50 because that's the bank's problem, right? Because he's not gonna lose more than his equity, because he just sends the bank the keys to the building. The problem is the banks own loans on a lot of buildings, right? I might be a landlord. Maybe I own one building, maybe I own two buildings, but that same bank may hold the mortgage on hundreds of buildings, thousands of buildings. So the losses for the banks are going to dwarf the losses for individual landlords of these properties. And now that has big implications for everybody, because when the banks lose money, well, what about the depositors, right? They're creditors of the banks. They've loaned their money to the banks. The banks took that money and loaded out against commercial real estate that has now crashed, and so they no longer have the security to make good these mortgages. So this whole thing is going to implode. And what does that mean? More bailouts, more money printing. And when I was in Europe, I think it was two summers ago, I was looking at property. I didn't buy any, but I was kind of looking at it, and some friends of ours were looking at property, but really looking at property in Switzerland, in Italy. We were there for the summer, and they were giving out loans. I'm not making this up. And they were arranging these loans through brokerage firms, but they were actually paying you. It was a negative interest rate to buy a property. I don't remember what it was, like negative 50 basis points. But of course, remember, in Europe, right, they had negative interest rates. So you were able to buy a property and get paid to do it. Now, you had to agree to put some money up with a broker dealer. There was certain things that I had to do in order to qualify to get paid to buy a place with a loan. But it was there. And I remember thinking that this is so absurd, that the real estate market has got to be way out of whack to the extent that people are able to do this. How many people were buying properties simply because they were being paid to do it? And even if you weren't getting paid to do it, if you can buy it for free, no money down, then obviously there was a lot of demand that would not exist in a normal interest rate environment. Well, now we're beginning to have a normal interest rate environment. We don't even have one yet anywhere in Europe or the United States, because I still think that real interest rates are too low. Despite the fact that they've gone from 0 to 5%, when interest rates were at 0, most people believed that inflation was below 2%. Now they can see it's at least 5%, if not more. So we still have negative real interest rates. In fact, in the UK, right, they're way negative, right? Because I think their year-over-year inflation rate is like 8% still, or 10%, something crazy like that. And so they still have huge negative rates. But the markets are still distorted, and interest rates still have a long way to go up. So the residential market is in trouble. The commercial market, that's something that we didn't have in the 2008 financial crisis. That crisis was restricted to residential mortgage, because that's where you had the adjustable rate mortgages, the zero down, the liar loans, right? All that cheap money was concentrated in residential real estate. This bubble not only includes residential real estate because rates were at 0 for a decade, but it includes a gigantic commercial real estate bubble that has just run into the mother of all pins, right? Not just the pin of normalizing interest rates, but the workers that aren't going to the office and working from home, and AI, which is just starting, which is going to eliminate more workers. So this is a much bigger financial crisis. It's a much bigger real estate crisis. Just if you focus in on the real estate aspect of it, this is worse than 2008, except real estate is only one part of it, because you got the entire stock market, you've got credit cards, you've got student debt, you've got everything that has been impacted by over a decade of 0% interest rates. The bubble that we have now that has only started to deflate, and we've barely seen the early stages, right? We've barely seen the tip of this huge iceberg, right? When I said that with subprime, when we saw subprime, I said that's the tip of an iceberg. Everybody said, don't worry about it, it's contained. I would say, no, it's a tip of an iceberg. Well, what we've seen so far with these bank failures is a smaller tip of an even bigger iceberg. And so there's a lot more left that we're going to see once it rises above the surface level. Anyway, that's it for today. I'm going to be heading back to the U.S. early tomorrow morning. So I got to hurry up and pack and get to bed. And I will do my next podcast back in the U.S. of A. From my summer home in Connecticut. Bye for now.
Hi, everybody. So I decided to call this impromptu live webcast of my podcast based on the Fed's actions earlier today. No, I didn't realize that this is how I would be spending my day. For those of you who don't know, I am 57 years old today. And I guess this is my party, with everything on lockdown and social distancing. This is what passes for a social gathering these days. This is probably the closest thing to a party I guess I'm going to have, although I'm sure we'll have some kind of meal here later this evening at my house, but we won't have anybody over for obvious reasons. But I really wanted to talk today kind of live during the market hours, take everybody's questions again. But there's probably one thing that is spreading right now throughout the country faster than the coronavirus, and that is economic ignorance and misinformation. It's all over the place. It's gone completely viral. And I want to see if I can help put a stop to that, which is why I suggest that anybody who is watching this video blog now, take the opportunity to tell some people that that you're watching and that they should watch too, because the best thing they can do to combat the virus of ignorance is to turn off their television sets or their computers and don't listen to anything that is being said in conventional media, whether it's a news-related channel or a financial channel. I can virtually assure you that every single thing that you're hearing is wrong. I can also tell you that everything that is being debated on the floor of the U.S. Senate right now is wrong. And our leaders are now repeating the mistakes that they made in 2008. And back in 2008, I was a very, very vocal critic of the financial crisis. Of what the government did in the aftermath of that crisis. Remember, I was on television all the time predicting the crisis for exactly the reason it was going to happen. So it didn't surprise me. It surprised everybody else in financial television and on Wall Street, but it didn't surprise me at all. And I remember when they first announced the TARP, I was booked on the Cavuto show that day. He had a special live show. I think maybe it was even on a weekend, like a Saturday or something. And I was booked on live to come because I was going to talk about how this was such a mistake and how we shouldn't do it. And I remember I got down there And while I was waiting to go on, there was some kind of bomb that went off somewhere. I can't even remember where it was. It wasn't in America, I don't think. It was in Afghanistan or someplace. I don't remember. And so they immediately cut to this coverage. And so I was about to go on. I'm sitting in my chair in the studio in Stamford. This is before I had my own studio in my house, which I also have in Puerto Rico, but I'm not using it right now. I'm just using my computer and my laptop on my desk. But I was sitting there in Stamford waiting to go on television to talk about TARP and why it was such a mistake and why we were doing the wrong thing and why it would be much better off if we just swallowed our medicine now. I was going to explain the mistakes that led to the 2008 financial crisis, why the Fed made those mistakes, and why it was compounding the mistakes now, and that the worst thing we could do was bail out those banks with TARP, that we needed to let banks fail, not because it was the easy thing to do, but because it was the hard thing to do and the right thing to do. And I was going to say, and I did say back then, that if we didn't swallow our medicine in 08, it was going to be much worse in the future. Well, you know what? Welcome to the future. And, I ended up having an argument with some Cavuto that day because they cut me and they didn't put me back on. And I was quite upset that I didn't get a chance to speak because I thought I was the only one that was going to say anything valid and that was going to warn about the financial crisis. And basically, as a result of that argument, he stopped having me on his shows. So I haven't done any of those those Saturday morning shows on Fox News anymore. But in any event, and I actually apologized to Cavuto because in retrospect, I think I got a little out of line with my anger because I was really psyched up about being on that show, and I had come back from the city especially to do it, and I really felt passionate about the fact that the country was making a big mistake, and I really thought I needed to get on the air, especially since I was really the only person that had been on Fox that had actually predicted it. But still, whatever I tried to apologize, but I to this day I haven't been able to repair the rip. That's only one reason that I'm probably not on Fox. I mean, look, I'm not on a lot of other networks. I'm watching CNBC today. I haven't been on in years. And again, it is very frustrating to see these complete fools. And some of these people that I'm saying are fools are very smart people. They're just fools when it comes to their understanding of economics. And these same people who were so convinced that that the Senate needs to pass another bailout today. Well, it's the reason that we bailed everybody out in 2008 that we need bigger bailouts today. And we don't need bigger bailouts. We need them like a hole in the head. What we need to do is the right thing. But now doing the right thing is so much harder because we didn't do the right thing when I wanted us to do the right thing in 2008. And if you remember, back then, I warned that QE was wrong, that 0% interest rates was wrong, that we were going down a path that we could never turn from, that it wasn't just going to be QE1, which nobody even knew was QE1 but me because they didn't have QE1 until it was QE2. But I knew from the beginning. In fact, I knew QE was coming before they started it. I knew what they were going to do before they did it. I wrote about it in my book, Crash Proof. I just didn't know what they were going to call it, but I knew what it was going to be. And now they won't even call it QE anymore because they're too embarrassed to call it that. So who knows what they call it because they don't even have a new name for it. But when they did it in 2008, I said then, this is a mistake. It's never going to end. It's a monetary roach motel, more QEs than Rocky movies. Whatever the analogy was, I thought of it and I repeated it over and over again. And I said that the Fed could never get off of this once it started, that it would be QE infinity. And you know what? Now it officially is. The Fed finally came out today, which is why I'm doing this, and made that 2008 forecast a reality by officially declaring that they will buy as many government bonds and as many mortgage bonds and as much commercial corporate bonds as it takes, which means they're going to back up that truck and they're going to buy it all. The Federal Reserve is going to buy the entire bond market. And this is what I said was going to happen because they are going to unleash a tsunami of inflation. And nobody would be dumb enough in the private sector to buy any of those bonds. And I said this from the beginning. I said if the Fed does this, eventually they're going to have to buy muni bonds. Eventually they're going to have to buy corporate bonds. I said this a decade ago, and they're doing it now. And they're using the coronavirus as the excuse. The coronavirus is going to be a scapegoat for everything that they do. But don't believe them. The reason we are so vulnerable to this economic downturn is not because of the coronavirus. I've said that from the beginning. That's the pin. The problem is the bubble. All bubbles find a pin. Doesn't really matter what it is. Now, I didn't foresee this particular pin. I mean, this is really probably one of the worst pins that any bubble could have found, but it didn't matter. But the problem is, had we done the right thing in 2008 and let businesses fail back then, let people lose money back then, far fewer businesses would be failing now. Far fewer people would have lost far less money than they're about to lose. And it's not a question of how much money people are about to lose. No. It's much worse than that. What we're going to suffer as an economy is far worse than losing your money. Because you know what's worse than losing your money? Having your money, but your money losing its purchasing power. That is the worst thing that can happen. And that is what's going to happen. Hyperinflation has gone from the worst case scenario to the most probable scenario. And that means people have to act quickly to protect themselves. Because, had we done the right thing,
A lot of people have been pulling their money out and moving it over to Merrill Lynch and putting it in a money market account where they can earn about 5%, which of course makes sense. The banks can no longer attract deposits. How do you have banks where you can't have depositors? Because they can't afford to pay the depositors any interest because they're broke, because the banks have already loaned out all their money for 30 years to the U.S. government or to American citizens. I've got a mortgage with that same bank. Bank of America has my Connecticut mortgage, and I'm paying 3.25%. And there's still more than 25 years left on that mortgage. They are eating it on that mortgage. They're losing a ton of money paying, only collecting 3.25%, right? And I warned about this as I had the mortgage, and as I was talking to people about this, and everybody was so excited about how great it was that everybody could refinance their mortgages. I just kept saying, it's great for the borrower. It's going to be a disaster for the lender. And of course it is. And the Fed doesn't want to put any more pressure on the banks by raising rates even more. It doesn't want to put any more pressure on the commercial real estate market, which has a massive amount of pressure on it already. So the Fed is looking for a reason not to hike. And so, they probably come up with one. But the minute they do this, I think you're going to finally see a drop in the dollar, like the next leg down in the dollar, which is going to spark a move up in commodity prices. The stock market already rose on anticipation of a Fed pivot, but we haven't seen any of that in the gold market. Gold prices, they did spike about $20 on that weaker than expected jobs report, or not jobs report, unemployment number that came out on Thursday. But we're still just trending sideways. We're holding below 20,000, 1,960. But we haven't seen an explosive move up. We haven't seen a big breakout in other commodities, oil, nothing. It's just been the stock market that has basically been the big mover, moving on anticipation of the change in monetary policy, moving from a tightening cycle to an easing cycle. But I think if the Fed doesn't hike next week, that could be the catalyst to get the dollar to resume the bear market or enter a bear market, get gold to break out and into new highs well above 2,000 and continue to move. And I think that is going to start to put a lot of upward pressure on consumer prices. I've been saying I think we're near the trough in year-over-year CPI, and I think we are. The last couple of CPI numbers have been worse than expected, meaning higher increases, month over month, year over year. So we've kind of bottomed out at around this 5%. I mean, miles away, not even close to 2%. And then we're going to start heading up. And here's going to be the problem for the Fed. As inflation starts to pick up, after they've already paused and as the economy is weakening, and especially if they've started to cut, right? So, because they may start to cut rates before the inflation numbers really start to get bad. But if they're not really bad before that first rate cut, they're going to get bad after it. And I think all this is probably going to happen, before the 2024 election. I'm going to talk a little bit more about that after I finish talking about this, because there's a lot of political news that has just come out. And I want to get to that. But I think that rather than the Fed fighting inflation, it's going to be the government that tries to fight inflation, but not in any way that's going to work. I think they're going to impose price controls. And that's already happening right now in France. I've been reading these news stories. In fact, I tweeted about one today that the French government has basically forced French supermarkets, right? So right now it's just in the food sector, and maybe it's going to spread to other segments of the economy. But the French government is applying financial pressure to the supermarkets, grocery stores, not only to stop raising prices, but to actually cut them. And I think prices are going to be cut maybe 2 to 8%, something like that, on all these different food items. Now, this is not the reason that there's an inflation problem in France. It's not because the grocery stores are gouging the people. It's because the European Central Bank gouged the people with money printing. That is why prices are going up. Christine Lagarde, Mario Draghi, particularly Draghi, because he was there for a lot longer, he kept saying that the problem in the Eurozone was that there wasn't enough inflation. His main goal as the head of the ECB was higher inflation. Well, he succeeded. The goal of the European Central Bank was for the cost of living to go up more because it wasn't rising enough, and that would include food. So the fact that food is more expensive is the consequence of a deliberate effort by the European Central Bank to increase prices, right? Well, they succeeded. And also, all of the budget deficits that are being run by the European governments, including the French government, which the ECB has been monetizing. So these supermarkets, they're not causing the inflation. They are responding to it. They are victims of it. In fact, many of these companies, and I own stock in quite a few of them, but a lot of these companies, even though they raised their prices, they didn't raise them enough. Their costs went up more. And the French politicians are now saying, hey, look, your input costs have been going down. Why aren't you cutting prices? Well, the reason is because they didn't raise them enough when the import costs were rising. In fact, initially, as costs started to go up, a lot of these companies were reluctant to raise prices. They thought it might be transitory. They didn't want to risk alienating their customers. And so they were behind the curve. And so now that some of the raw material costs are going down, you can't say, oh, we're going to immediately start cutting prices if we haven't even raised them enough based on how much their input cost already rose. But no, right? The politicians weren't, mad at the supermarkets for not raising their prices when their costs went up. But now they're pissed off that they're not cutting them when their costs went down, even though they probably still haven't raised their prices enough to keep up with their costs. Their margins have suffered. I know that as a shareholder. But what I've been expecting is for the companies to eventually catch up by pushing on, more price hikes. But now that's difficult, at least in France, because the French government is not allowing this to happen. And so this is going to have broad ramifications in France. The one thing it's not going to do is produce lower food prices, because what's going to have to happen is these grocery stores, supermarkets are going to have to figure out other ways to make up for this loss. And so the customer is going to feel it one way or another. They're going to find ways to reduce the quality, or they're going to come out with new cuts of meat that they can put a price on that won't be a price hike because it's a different product. They're going to repackage stuff. I mean, things are going to happen. Or, there's just going to be less supply. And maybe you're going to go to the supermarket and there's just not going to be enough stuff there. Maybe some of the items that the supermarkets are not allowed to price correctly, well, they'll just stop stocking those items. So they're not going to raise prices because they're not going to have the products anymore. And so that will have accomplished the goal of the French government. Prices won't be going up, but it won't matter because there'll be nothing to buy because the stuff won't be there on the shelves. So now the supermarket can say, yes, we didn't raise our prices because we no longer stock those items because we can't sell them profitably without the politicians, sanctioning us. But the reason I'm bringing up what's going on in France is because I think that's coming to a theater near us pretty soon, because that's basically all they're going to have. When the price increases start to accelerate after the Fed has cut rates, right? What are they going to do? The Fed can't reverse and start hiking rates if it's just started cutting them. And so if the Fed is powerless to do anything about the resurgent inflation, that's going to leave it to Congress, to the president, who might do it by executive order. And what could he do by executive order? Well, I guess price controls. That's what I think Biden is going to do, especially if he's looking bad in the polls. If inflation is a big issue, how is he going to do anything about it? Well, he's going to try to order companies to stop hiking prices or reduce prices, just like France is doing it right now. And that may be the only way to help his chances of being reelected.